GDP numbers because we know that the GDP is really the economic viability of that country, that province, that city, and that.
This is a very common sentiment, but it's simply not true. Now, the GDP statistic does measure what it purports to measure, which is the total spending in the economy. But it's flawed in one fundamental way. Well, it's actually flawed in a number of ways, but there's one very important flaw, which is that it counts government spending on par with private sector spending. Now, GDP's an okay proxy for how wealthy a country is, since just like with personal incomes, the more you can spend, the more money you have. But it's not as great a indicator of the trajectory of a country. So somewhere along the line, people began to equate GDP with the health of the economy. And this is a very simple and comforting thing to do, but it's really not the case. There's just so many variables at play which aren't captured by the GDP statistic. A better measure would be private sector spending, or maybe total production. I mean, if the government started a massive program, bought up $1 trillion worth of cars, and drove them into the ocean, the GDP figure would go up dramatically. But nobody can possibly think that this would be productive, or that it would lead to the wealth of the nation accumulating. We've seen extreme growth in the public sector in Canada over the last decade. And this is keeping the Canadian GDP at a certain level. But it's really a facade. What the government spending is doing is masking a big flaw in the economy, which is that not as much real wealth is being produced.
That is what real estate attaches to because GDP leads to jobs, jobs lead to population growth, and those three things power the real estate market, even though right now it's being totally influenced by interest rates, politics, lack thereof, so on and so forth. We always here at the Real Estate Investment Network and on this show get anchored to what's going on in GDP. So we got a cool little chart here in terms of comparing
I just gotta say, this guy's got a really stellar look.
whether it's a hard landing, soft landing. We'll see where that's going. But GDP and CPI, because those two things are very interesting, Patrick. As GDP is coming down, so is CPI, which is exactly what the Bank of Canada is hoping for. Question is, have they seen enough of it in order to take their foot off the brake and kind of bring interest rates down so we can get back to making, get back to good business here. All right, folks, here's what we're going to do. For everybody who likes and subscribe this week, Patrick is going to do 5 push-ups for everyone who likes and subscribe. So let's jack it up. And then, Patrick, I want you to post on YouTube all the push-ups you have to do.
Okay, done. I'll even put it on Instagram because I'm into the physical challenges these days.
Like, subscribe.
Comment.
Yeah.
Well, it's such an interesting dilemma that the Bank of Canada faces. And ultimately, we have these challenges called by bringing the interest rates down. But we know that if they bring interest rates down, what's going to happen? The economy is going to heat up again because housing is going to be, which is what really drives our economy right now, is housing.
I mean, what we really need to do is do away with the whole fiat money system. We need to abolish the Bank of Canada and return to a gold standard. I will say that overall, the Bank of Canada has done a much better job than most central banks in combating inflation and in maintaining high enough interest rates. But the reality is, we shouldn't have any inflation at all. Inflation is just the government printing money, and it's an invisible tax on anybody who has savings. It's a transfer of wealth from anybody who's holding cash to the government. Basically, it's little more than legalized counterfeiting. And there are a lot of harmful effects to inflation. It can trigger malinvestment. Obviously, we've all seen prices go up. And prices don't go up equally either. So it depends where the new money goes first. But certain consumers and certain segments of the market are hit harder than others. They call it Cantillon effects. Inflation also contributes to militarism and war because going to war is extremely expensive. So it requires both the ability to levy taxes and the ability to debase the money supply if you want to finance it. But going back to the Bank of Canada for a second, if you participate in online discussions, then I guarantee you heard people talking about inflation in the last couple of years, and you say, "Oh, it's the Bank of Canada's fault." It's you point the finger at the central bank, and somebody will say, well, actually, inflation's everywhere. It's in the European Union. It's in the United States. So how can it be the fault of this central bank? And I'm sure you've heard that. I've heard it myself so many times anyway. And and the thing is, they're all uh, engaging in the debasement of currency in unison. In unison, they're all printing money together so that there's no there's no change in the relative value of the money. I mean, finally, people are sort of coming to their senses and realizing that, you push the interest rate low enough, you keep the easy money policy going, expanding the money supply like crazy, and you are going to get really bad inflation like we did for a while there. So they're starting to sort of reel that back in. But the reason why inflation in the last few years, which is such a widespread phenomenon, it's not supply chain issues. I mean, there's always something going on in the world. I mean, goods want to get to market. People are out there working, COVID or not. It's that's a load of Huey. It was monetary policy. Government spent like crazy during COVID. Massive giveaways to businesses and individuals, more so to businesses. Corporate welfare on an unprecedented scale. And that was monetized, that was financed, monetized through the banking system. So yeah, when you run a $400 billion, $500 billion deficit in a country where total federal tax revenues are like 300 billion, and you just print the money to pay for it all, that's going to cause some inflation.
They're already, they're trying to front run. People are trying to front run the possibility of rates coming down. So now the Bank of Canada is really confirmed that if we bring rates down, we know inflation is going to come up. On the other side of that equation, if they don't bring rates down or they actually threaten to increase rates, we have another problem, which is the fact that the economy will slow down dramatically even more. And keep in mind, JG, when we look at our productivity chart, our productivity isn't real. It's like, even don't even use the word productivity because it's not productive. It's still a very soft economy being driven by housing, and we got lots of work to do.
Oxford Economics here is fascinating because they're predicting Q3 of 2023. They're predicting GDP that's going to be negative in Q3, negative in Q4, negative. That's 2023, which, by the way, Q3 2023, those numbers were revised up, right, Patrick? I believe, if memory serves me right. Q4 2023, Oxford Economics is predicting either flat to slightly negative GDP. And then they're definitely predicting Q1 2024, which is what we're in right now. Like, we're right in the middle of it. They're definitely predicting that one to be, again, zero to negative. And then we start to bounce back, according to them, in Q2 of 2024, and then we start to ramp back up. What I'm curious, and I wish they would have put on their chart here, because you can see on the top of the chart, you can see how this is going to have an impact on CPI. They expect CPI will come down as the economy lands softly or doesn't, whatever the case may be. I'm curious to see if you overlapped interest rates on this chart, where interest rates would go, because now everyone's got their own opinions on where interest rates are going to go. And some people are going to say we're not going to see any interest rate cuts until way.
And what this chart is showing to me is that our economy has stagnated, that it hasn't really grown for the last 10 years because it's fundamentally not solid. We've got extremely high levels of government spending. Government spending is, officially 42% of GDP, which is extremely high. It's among the highest in the world. Sure, France and Greece, these countries are higher, but it's still extremely high. We've got so many government programs, so much government money going to people so they don't have to work. We've had persistent inflation. Okay, it's not extremely high, but it's persistent, and it's still encouraging debt. We've got a debt-based economy, an economy based around the consumption of wealth, not the production of wealth. Very few people are saving, so we're relying on corporations to save for us, which, sure, it's happening, but then we've got a society not of owners, but of customers and of employees, which is why so many of the jobs now are part-time jobs. We saw in the last quarter the economy is shedding full-time jobs, and instead a lot of part-time jobs are being created, and a lot of government jobs are being created, which is just putting more stress on the actual productive economy, the private sector. We've got a government and a lot of political opposition to commodity development, to mining projects, to oil and gas, and politicians have been relying on the panacea of immigration. But look, immigration is great if the economy is fundamentally sound. But when you've got a massive welfare state like we do, when so little wealth is being produced, having more people come in, that's not necessarily going to help anything. It's certainly not the quick fix that Justin Trudeau thought it was going to be. So we've got extremely low levels of entrepreneurship, and again, very little retail saving, consumer savings. And then we've got these massive scams like public education, which is a huge sector of our economy that, again, it's not producing tangible wealth. And frankly, it's not producing a lot of intangible goods either. I mean, you look at what's going on in a lot of the colleges and in the universities. I mean, basically, it's obligatory now. Everybody's got to go 4 years of post-secondary. Otherwise, it's difficult to get a job. But it's a massive waste of taxpayer money. I mean, the taxpayers are subsidizing this all to the hilt with the student loans. And now we're milking international students as another means of raising revenue. And that's fine for the professors and the TAs and the university brass, but it's not doing these foreign students any good. It's not doing Canadians any good. We're churning out gender study graduates who don't know how to do anything except whine about how oppressed they are. And the amount of fraud and waste that goes on in this system. You've got diploma mills that they're not doing any real educating there. Everybody's cheating. The whole system's set up so they can cheat. There's no oversight. I mean, don't get me wrong. Canada does have some phenomenal universities, some phenomenal programs, but there's this whole other aspect to post-secondary All these people that don't really need a post-secondary education that should just be going into the workforce, but they can't because uh, because post-secondary education is an effective sorting technique for employers, right? So they can say, well, this guy, you know, they can at least sit through 4 years of this nonsense. They can do these series of tasks to a reasonable proficiency, and that's already been done. So they might as well take advantage of it. But it's such a ridiculously expensive method of sorting through applicants. When absent all these subsidies towards post-secondary education, absent, the guaranteed student loans, there would be such a smaller market for post-secondary. People that are really hardcore academically inclined. Everybody else could just do like a little vocational training or on-the-job training. I mean, mostly you get trained on the job anyway.
Late in 2024, if not 2025, people are saying now, Patrick.
I'm starting to think that myself when we look at the dilemma that the Bank of Canada has, given what's going on economically. It is a very, very complex situation that we find ourselves in. And we've never found ourselves here before because there's so many global macro issues that are happening, as you know. And even with supply, when you look at what's happening in Panama, Panama Canal, and the shutdowns and the lockdowns and boats not being able to get through. I mean, there's a lot of things that are happening, but we also don't need the inventory. So it's just this weird dynamic of where our interest rate's going to go. But I have a tendency to agree. I think that the Bank of Canada is not going to be quick to bring the rates down. As I sit here today, that's what I look at.
I hope they aren't. I mean, monetary policy is simple. It's actually incredibly simple. You just need to keep the money supply stable. Don't create new money. That's all there is to it. Any amount of money is enough. And there's this mistaken belief that creating more money creates more wealth, but it doesn't. Wealth is physical, tangible stuff. Money is just a medium of exchange. Any amount of money is enough. You don't need a fixed percentage increase every year. You don't need to print money when there's a recession. You just need to keep the money supply stable, and that's why a hard gold standard is the best, because every dollar's got to be backed by gold. It shouldn't even be government run. That's what it was in the 19th century in America. Banks were issuing their own private notes, and because it was all separate banks, then as soon as one of those notes went to a competitor bank, it would be immediately called upon for redemption in specie, aka gold. So that was the ideal sort of situation. And that's why during the Gilded Age in America, Canada too, for the most part, you saw extremely high levels of growth. 5% a year, wages increasing 40% over a decade. People think that it's natural for developed economies like Canada to have such languid growth, but it's not. It's a result of policy. It's a result of monetary policy, and it's a result of fiscal policy. What we need to do is return to laissez-faire to make substantial reductions in government spending across the board. Every department, we got to look at eliminating some ministries and auctioning off some government assets and returning to a hard money gold standard, gold and silver standard. That's the secret. That's the road to prosperity.
Yeah, it might be changing next month, but I think ultimately the lag in GDP, I think we're going to start to see, and we won't know this, by the way, until the second quarter of 2024. But I think the first quarter of 2024, where we are today, when we finally get the real numbers, we're going to find out that it's slowed down a lot more. We can't negate or minimize the reality of these.
All right, well that's enough for me. I don't know who these guys are, but yeah, I'm out.